talked about this imbalance here and how we filled it in. We would expect bearishness to unfold from there. We did. We saw it go lower, and then we returned back to it here. So this is a reclaimed PD array. It starts to sell off, and I said that if we go back to it again as a third time, we do not and we would not expect this area to offer resistance. We would expect it to give way, come back down in, and find some support. Now this is a little muddy in here, and we traded back down in this imbalance a little bit. But this, I would attribute that to the fact that we're towards the end of the year and it's this holiday volume. But when I was talking about using reclaimed PD arrays, and if they've been reclaimed, we do not see them do it like a third time. We would expect them to fail and run through that and then use the levels as support. In this instance, we look for it as resistance or a premium, and then it's going back up into it here. Go back and listen to Monday's video again, and you'll hear me outline the very thing that you're looking at right here. We trade up and through it. It doesn't even stop here. So it's not resistance. It's not like this high here and this high here. That's resistance, because look what it did. And it's not, it's breaking here and coming back down like you would expect it to rally here with support and resistance ideas from the retail crowd. Nope. Then it goes down here. How's that support and resistance? It's not. But watch what happens. It rallies back above. Boom. Then it hits the level. Premium high right there. The logic is we went through it, disrupted anyone that wants to buy it, and then we trade down into it as a Judas swing here. Consequent encroachment. Rallies. Market structure break. Institutional order flow entry drill. Rally. 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 Each new pass is squeezing on anyone that's short, inducing short covering for long-term bears on pound versus dollar. So this is right out of what I taught on Monday and how to use reclaimed PD arrays, but also understanding when they have been reclaimed. On the third time revisit to it, you expect them to fail. Okay, so when you look at things like when I'm on YouTube videos, or if I've done videos where I'm annotating the chart live and typing up what I think is going to happen, or it's going to do this, or it should respect that, or it shouldn't do this and shouldn't do that, I expect it to run through this level. It's this very logic I'm using to do those types of things. Okay, it's the element of reclaimed PD arrays, and then once they've been reclaimed, they are no longer effective in the original form of either premium or discount. They will likely invert, okay, and whatever they were using as a narrative for bearishness in the past or bullishness, it will be used for the opposite later on, and you can see that here. All right, so bullish reclaimed order blocks. Okay, so there's lots of things you can do with order blocks, but when we're looking at the element of reclaimed order blocks, the first and foremost thing is you have to understand where is it likely to go. Okay, where's the draw on liquidity? So we know there are times when we can look for a draw on liquidity, and a bias can be determined based on that. But that has to be understood. If you don't understand that, you're not going to know what a reclaimed order block is. You're not going to be able to identify it real time, and you won't be able to trust the logic. So that's why I teach the way I teach, in terms of understanding where the market's likely to go and what barriers would be there that would prevent it or slow it down. So that assumption is being used here in this teaching. But we're going to assume that you believe that your analysis calls for a higher draw on liquidity, okay, or buy side liquidity. A reclaimed order block, and there's a couple things I want to cover in this because this is a really crude depiction, but it'll still accomplish the means. The short-term low that forms, okay, it's going to be some kind of old low that's ran out with sell-side raid, or it's trading down into a discount PD array that you would expect to see prices rally from. So that's an ideal scenario. The market rallies and creates a short-term high, breaking market structure. Okay, so this could be a short-term high, or it could be another short-term high over here. But once that market structure has been broken to the bullish side of the market, then you're going to go right back to this down close candle. That is your order block. You're going to wait for it to return back down into it. That's your first run into the order block. That's a buy. Your stop goes below here. The way I teach you in this mentorship is you're not strangling your positions with your stop loss. In other words, you don't enter, and as soon as you get this one candle up, you don't go from your stop here to right under there. The reason why is what I'm showing you here, because it can return back into that order block again. Now, the first return to the bullish order block, that right there is the ideal entry, because you may not get a reclaimed order block. And here's the thing. You will never know, I never know, if they're going to reclaim the order block. I don't know that. Okay? And I'm going to tell you how you can trust that it could still potentially happen and when it's no longer a factor. That's what I'm going to show you here now. Once you get the order block traded to, and if you enter there, you want to see it repel. It does. You go back to the point at which this point number 3, that's where market structure broke to bullishness. Okay, so in other words, there's some short-term high over here, or maybe over here that's not being depicted here, because I want to take your attention to the heart of what makes a reclaimed order block. Number 1 spot is returning that down into the down close candle. That's your bullish order block. That's what you buy. Your stop will be below this low by 1 or 2 ticks or pips. When it starts to rally, that's what you want. You want to see that. But it can do this, fall short of where it broke market structure, and then go right back down in, take out that candle that you entered on, and go deeper into the order block. That is a reclaimed order block at point 2. What makes it a reclaimed order block is because we did not take out the high that formed the break in market structure. So we're stuck in what? We're stuck inside the dealing range between the low that starts the order block here and the high here. So every retracement since this candle's high, we're stuck in this dealing range. Okay, so the logic is the order block was used to take the long entry here. Your stop is framed with a stop below here. When we dig down into it deeper, this is a reclaimed order block. It's returning back into this down close candle. You would expect the likelihood of that happening because we did not yet, on this run here, from the entry up to here, we did not take out that high. Now, once it does this and it rallies again, you're waiting to see this high taken out at point 3. Once that occurs, you have now broken market structure twice to the upside. There is no reclaimed order block with this candle here again. It won't do it again. For it to come back down to that again, that's a failure of the trade, and you would protect your stop by collapsing the trade before it gets your full stop. Very, very simple, isn't it? Now, this is the underlying factors that you have to be worried about, assuming that you understand that the draw on liquidity is somewhere up here. But you have a down close candle that starts a run that sees a break in market structure that's bullish. It returns to the order block here, you buy. It rallies, but fails to take out the area where it rallied to break market structure to bullishness. Then it retraces back down. It's dealing inside this range from this low to the high. You're trusting your stop will not get tagged. If it does, so what? So what? I'm not teaching you 100% trading because I can't do 100% trading. But you have to have logic in what you're doing and what you're looking for. So when the market trades back down, you're not panicking. It may go lower than where you entered. You may go into a little bit of a drawdown on your trade. It's okay. Let the stop do its job. That's what you're paying it for. You're paying it good money, hopefully not too much money, but you're paying enough to do its job to protect your account from blowing out. Because if it goes below that low here, that's not good. It's not bullish. But it can dig a little bit deeper into this order block, go deeper than your initial pass, then that's what's occurring here. That's a bullish order block that's being reclaimed because it has yet to take out the area where the high formed breaking market structure to bullish. But now you have this dealing range it has to overcome. And you're anticipating the draw on liquidity up here somewhere being the eventual draw for price to go higher. And they see price drop it down in here. And that all this is doing is the algorithm allowing interbank traders to pick up more buying in here. And then it rallies. Now, for your notes, Where this first return in the order block and then where it goes back down into it again for the reclaimed order block, in other words, revisiting an old order block, you only allow that twice, never a third time. But in addition to that, the time from where it first goes into the order block and when it reclaims, there is no time limit. There's no time limit. There's no definitive number of candles. There's none of that, okay? So that's why you have to focus on this range high and this range low. And then expect the distortion of time in your chart, because there's going to be periods between where New York session closes and then Asia opens. There's slow periods. You're not worrying about that, okay? So you have to anticipate a lot of meaningless movement in here, but not taking your stop and not taking out the high that creates the run-on bullish market structure. So when the market just trades in like a tight range and it doesn't look exactly as nice and neat like this, in between these 2 points here, 1 and 2, this might be hours of data. But I've shown you how to remove periods of the marketplace. I physically took the parts out of the chart and show you what my eye sees. And I'm showing you here, by example, the range low and the range high. That's what I'm factoring my attention on. And I don't care how many candles it spends in here after it hits the order block here. I don't care. So as long as my stop hasn't been taken out, I'm going to hold the trade with the expectation it's going to eventually move in my favor. And I might have to submit myself to the time of hours before it gets into the next trading session, like London or New York. But while it's trading what would be viewed as aimlessly or in narrow consolidation, then it might drop down into that area here, and it will look like to other traders, oh, it's breaking lower, go short, when it's really just going back into that order block here that frames that range. So just like I outlined in recent weeks with the POW dealing range and how effective that is, knowing what you're looking for, everything else outside of the range low and high is of no importance right now. What it's doing inside there, we're just trusting the logic that's going back down to the order block, and then it may go down to it later on and then create the run. So you have to submit to it. And just also understand that your chart is plotting price on a time basis, not a volume of trade or how much trading is going on. It's marking time with wherever the close is at that interval. And that's the problem with charts. And I do my best to try to help you decipher and remove all the chaff from that. So there's an element of time that allows you to just submit yourself to this logic. You have the order block and that old high where market structure is now bullish. And you want to see a second break of that to confirm bullish market structure. Once that occurs, then you don't ever expect this order block to be reclaimed again. The beautiful thing about everything I teach, everything is reversed. A bearish reclaimed order block is the same as what we saw here, just opposite. Market creates an up candle, trades lower, retraces back into that area here, which is your bearish order block at 0.1. And you want to see it break again, where 0.3 was a break in market structure on the bear side, some kind of short-term low here. It broke there. Then the retracement back into the bearish order block. That's your entry ideally. But it starts to go lower, but doesn't break market structure a second time bearishly. So we're dealing inside the range high and low. It returns once more back into the bearish order block here at 0.2. Then you would expect price to deliver like you were expecting. That's the other factor. Reclaimed order blocks, much like propulsion blocks, they usually provide a real quick, snappy reaction. Okay, so if you're seeing lethargic action, then you get a return back into that bearish order block at 0.3, down into a second run of bearish market structure being confirmed. So you have market structure being broken to the downside here, bearish order block, reclaimed bearish order block, then deliver quicker, faster pace run to confirm broken market structure to the downside, and then reaching for your draw on liquidity. And again, between 0.1 and 2, where there can be a reclaimed bearish order block, there could be a lot of time there, and as long as that dealing range high and low hasn't been given way, you just submit yourself to it and the stop. Okay.